Welcome back to Market on Close. I'm Sam Vardis on the floor of the New York Stock Exchange. Let's check in on the metals trade and other commodities with our next guest, David McAlvany, who's the CEO of McAlvany Financial Companies. David, thank you so much for joining us. All right, so we saw a nice bit of strength into month end, obviously driven by a bit of a flight to safety, no doubt, on some of the concerns that have been widely telegraphed, and we've talked about enough on this show already. But just talk us through some of that price action, what you think of it.
Yeah, I mean, this is a whale of a bull market. This is something that I think has legs, and the fact that we had a healthy correction at the end of January and found our feet here in February, very significant. Today, we're closing with silver at the highest monthly close on record, 85.31 previously, and so today puts us into new territory, breaking out. So we see a number of other sort of confirming breakouts. XAU, the metals index, breaking out against gold, closing this week at almost 9% as a percentage of the metals price, and moving into outperformance mode. Technically, we should see the next destination in the 17% range, so nearly a double in terms of the outperformance in the mining shares versus gold. There's a lot going on. GDX, GDXJ, both breaking out to all-time highs, kind of shrugging off this last correction in gold and silver and moving higher. And I think the last thing I would say is that XAU breaking out against the S&P 500, very significant. I think is we see capital reallocation and migration. There's reasons to look at this space as greener pastures, and investors are very underallocated to it at this point.
Can you talk us through some of those reasons? Because no doubt we know some of the structural drivers for this aggressive central bank buying, particularly with respect to gold. We know that that continues. But on a day like this, when you have obviously bonds rallying, equities pulling back, the VIX is up, some of those credit concerns and AI fears and a hotter than expected PPI, it kind of makes sense, but just talk us through some of the reasons as to, why you should be exposed to some of these metals.
Well, I think that the biggest picture issue is global debt issue. You've got, close to $370 trillion in global debt. We don't have an engine of growth that can support that. Over 235% debt to GDP globally. Here in the U.S., depending on whether you're counting net or gross, it's between 102 and 122% debt to GDP. And I think very concerning to foreign creditors, those who would look at the Treasury as a safe haven, which it's not. You see the percentage paid to interest now north of 20% of revenue. That's not really sustainable, and it's not like we're changing tax here, Sam. I mean, we have a penchant to spend at levels that we would normally associate with war, or go back to the days of the pandemic. This is reckless fiscal management. And we see the migration away from fixed income and bonds as being something that is structural in nature. And even Morgan Stanley suggested that maybe the 60-40 portfolio is passé. It should be 60% stocks, 20% bonds, 20% gold. That kind of a migration, asset allocation shift in the direction of gold is in its infancy. Most financial advisors would scoff at that. And yet it's the chief investment officer at Morgan Stanley who says that's important to consider. And I think the backdrop is that fiscal picture, not just in the U.S., but globally, where sovereign debt is a problem. It's not a place you go for safety. It's a place you go to lose capital.
Yeah, it certainly is a tone shift, particularly when you talk about retail investor participation as well. Just wanted to get your thoughts on what you thought of this CME outage earlier this week. I mean, it just seems like there was a lot of suspicion around that, a lot of confusion, obviously a lot of outrage as well. Just talk us through what we know about that.
Well, there's much more that we don't know. What we do know is that CME members protect their own. And if you look back to the 80s and from then to now, when metals get to high levels and if people are on the wrong side of the trade, of course, games get played. It's very appropriate to increase margin requirements as they've done responsibly in the last 6 to 12 months as the price of metals have gone higher. But the timing of that can certainly be suspect. And so I'm not exactly sure what to make of the CME outage for nat gas, gold, and silver this last week. But it did come precisely at a silver breakout point, at roughly $92 an ounce. So looking at the charts, that was an area to defend. And, at today's close, apparently they're losing that line in the sand. We've got silver up a healthy 6-7%. And so, again, games can be played on the CME and the futures market, and rules can change in the middle of the game. But I think the long-term structural supports for gold and silver are unquestionable. And retail demand in the form of ETFs has begun to increase pretty dramatically over the last 6 months. We see that in Asia, we see that in the US, we see that in Europe. And again, it's for the same reasons. We've got an unmaking and unraveling of global order. We have a tremendous amount of uncertainty, even this week, from a change in tariffs. And of course, wars and rumors of wars there in the Middle East. So I think there's good reasons to consider it. I'm not so concerned about the flash in the pan, wars or conflict. Of course, you see oil and gold as very emotional assets under those circumstances. But more to the point is that people are looking at a structural shift in inflation and a structural shift in interest rates, something that has many years. Keep in mind, in the history of U.S. interest rates, the average trend directionally, one way or the other, is well over 20 years. Actually, 36 years is the average. So when rates start to move higher, you're talking about something that ends up being headwinds for many financial assets, tailwinds to hard assets. And so I think what we have in 2026 is a growing awareness of the revenge of the old world and the basics, the things that drive the real economy, as opposed to things that can be somewhat pie in the sky. So much capital allocation has gone towards AI and tech, and I think that's about to roll out and look for greener pastures.
And what about the geopolitical risk premium, David, being priced into oil right now? Obviously, we're keeping an eye on Pakistan, Afghanistan, the US, Iran, and now, of course, OPEC, and whether they could, in fact, resume production come post-Q1.
Yeah, I mean, I think it's real. It's worth a few bucks in the price, and so it can either ebb or flow. More significant is your non-OPEC production, which has peaked. So, the marginal growth over the last several years has come from U.S. shale, and those days are behind us. There is no economic incentive at these prices for there to be sort of a drill baby drill policy. The White House may want it, but producers would look and say, why would we do it? Why would we put capital at risk when the math simply doesn't work at these prices? At $80, $90 an ounce, of course, they can start bringing the drilling rigs back out and increase production. But I think for the time being, we've got a flatlining and a declining of shale in the U.S., and I'd look more broadly at your other non-OPEC producers as well. OPEC's got some leeway, but not enough to matter. I think the glut story from 2025 has been overplayed. And if you're looking at tankers floating, if you're looking at where oil is stored, we do not have a glut. All of that is on spreadsheets. It's not in the real world.
Interesting. David, really appreciate it. Thank you so much for joining us today and unpacking your thoughts for us. Have a wonderful weekend. We'll see you next time. David McAlvany from McAlvany Financial Companies there.